Hey everybody, so today we're going to be doing a financial analysis and comparison of defense companies. We'll be looking at Raytheon, Lockheed Martin, Northrop Grumman, Boeing, and General Dynamics for the year 2017. I'm sure we've all heard of these companies at some point. I'm sure everybody's heard of Boeing. Most people have heard of Lockheed Martin. Uh, they're famous for several planes like the SR-71 Blackbird, and I'm sure we've all ridden in a Boeing airplane at some point. Northrop Grumman and General Dynamics aren't as well known, so it'll be interesting to see how these companies compare to each other financially. And we're going to do this by determining which companies we would most likely give a long-term loan to, uh, which companies we most likely give a short-term loan to, and which companies we would rather purchase if we had the money. So first, we're going to see which companies most likely give a long-term loan to, and we're going to be doing this by looking at their financial leverage and their earnings before interest and taxes, or as it's listed here, EBIT. Before we do that, though, we're going to talk about what financial leverage is and what earnings before interest and taxes are. So first, we'll look at financial leverage. So the financial leverage ratio is basically a measure of how much assets a company holds relative to its equity. So it tells you whether a company is funding through debt or equity. So generally speaking, a firm operates with a high operating leverage to make investment, and a high operating leverage means that a firm is making few sales with high margins. Next, EBIT is basically just earnings before interest and taxes, like I said. So it just, obviously you want a higher earnings ratio and a lower financial leverage ratio. So looking at the companies here, we can see that Boeing and Lockheed Martin have significantly higher financial leverages than General Dynamics, Northrop, and Raytheon. And of the three I just listed, General Dynamics has a slightly lower financial leverage and higher earnings before interest and taxes than Northrop and Grumman. Raytheon and Northrop Grumman. So, as far as which company would give a long-term loan to, looking at this information right here, we would probably go with General Dynamics, and we would least likely give a long-term loan to Lockheed Martin and Boeing, but probably Lockheed Martin, since their ratio between EBIT and their financial leverage is lower than that of Boeing. So next, we're going to look at which companies would most likely give a short-term loan to, and we'll do this through looking at different ratios than we would if we were giving them a long-term loan. We're going to look at current ratios, cash ratios, and quick ratios. So starting off with the current ratio, it's one of the best known and most widely used ratios, and is defined as current assets divided by current liabilities. And because current assets and liabilities are in principal converted to cash over the following 12 months, the current ratio is a measure of short-term liquidity. So to a creditor, particularly a short-term creditor, the higher the current ratio, the better. A high current ratio indicates liquidity, but it also may indicate an inefficient use of cash and other short-term assets. Generally speaking, we would want to see a current ratio of at least 1, because a current ratio of less than 1 would mean that the net working capital, such as current assets, is negative. And this would be unusual in a healthy firm, at least for most types of businesses. So as we can see here, all the current ratios are at least above 1, and Northrop Grumman is at 2.35. So judging by the data here, Northrop Grumman has the best current ratio out of all 5 companies. Next, we're going to look at the cash ratio. It's pretty straightforward. It's cash divided by current liabilities, and this one's particularly interesting to short-term creditors because cash is the most liquid of all assets. So we can see from the data here that Northrop Grumman has a much higher cash ratio than all other companies, uh, and Boeing would have the lowest at 0.18. So that's another you know check for Grumman as far as who we'd give the loan to. Next, we're going to look at the quick ratio, also known as the acid test. This one's particularly important because inventory is the least liquid current asset, and the quick ratio subtracts inventory from current assets and then divides it by liabilities. Inventory is particularly important to look at because relatively large inventories are often a sign of short-term trouble. For example, the firm may have overestimated sales and overbought or overproduced as a result. And as a result of that, the firm may have a substantial portion of its liquidity tied up in slow-moving inventory. So we can see here again that Northrop Grumman has the highest quick ratio, and Lockheed Martin, Boeing, General Dynamics, and Raytheon all have a significantly lower quick ratio. Boeing with the lowest. So, judging by all this information, we would most likely give a short-term loan to Northrop Grumman, and we'd be least likely to give it to probably Boeing, I would say. So next we're going to look at purchase equity, which basically means which companies we'd most likely buy if we could. To figure this out, we'll be looking at total asset turnover, profit margin, return on assets, return on equity, and price earnings ratio. But before we look at each one, we're going to talk about each one and determine how you solve it. Total asset turnover ratio is an efficiency ratio that measures a company's ability to generate sales from its assets by comparing net sales with total average assets. Basically, this ratio shows how efficiently a company can use assets to generate sales, and is found by dividing sales by net fixed assets, or total sales. So next, profit margin is found by taking net sales and taking net income and dividing it by sales. This ratio is probably the most important one to look at because it's very important that a company is profitable and effectively measures how much out of every dollar of sales the company actually keeps in earnings. Next, return on assets, or ROA, is a financial ratio that shows the percentage of a profit a company earns in relation to its overall resources, and it's commonly defined as net income divided by total assets. Return on equity, or ROE, is a measure of profitability that calculates how many dollars of profit a company generates with each dollar of shareholders' equity. The formula for ROE is net income divided by shareholders' equity, and is sometimes called return on net worth. Next, the price earnings ratio, or PE ratio, is a ratio for valuing a company that measures its current share price relative to its per share earnings. The price earnings ratio is also sometimes known as the price multiple or the earnings multiple, and it can be calculated as market value per share divided by earnings per share. So looking at each company's total asset turnover, they're all pretty much in the same ballpark, but Boeing and Lockheed Martin are above 1. Lockheed Martin being the highest, so that would be one reason why we'd look at purchasing a Lockheed Martin or Boeing. And next we'll look at profit margin, which, like I said, is probably the most important out of all these ratios. And here we see that General Dynamics has a significantly higher profit margin than the rest. Boeing is pretty close behind it, but Lockheed Martin is significantly lower than all other 4. So we would definitely still consider buying Boeing, but not so much Lockheed Martin. And out of all these, General Dynamics definitely looks the best. So moving on to return on assets. can see that again for this one. General Dynamics and Boeing both have the two higher ratios out of all five companies. And we can also see again Lockheed Martin again has the lowest ratio. So out of all these five, General Dynamics and Boeing both look pretty good. I would say that as of now, those two are the most likely companies that we would look at purchasing. And Lockheed Martin is still the least likely. So moving on to return on equity. First, it's important to note that Lockheed Martin did not have data for 2017, but its 2016 number was about 32, 33. So we would, I guess, say it's about, we're in the low 30s for 2017, even though the data is not available. So, as it probably stuck out to you in the chart, Boeing has a significantly higher return on equity than either company. As far as the other four, they're all pretty much in the same ballpark, 20s and 30s. But for some reason, Boeing is about 5 times what the other ones are, and I'm not sure why this is. I couldn't find any data as to why Boeing has such a high return on equity, but it definitely shifts our decision more towards Boeing as of right now. It's a company we'd like to buy, and still Lockheed Martin will be the least likely at this point. And finally, we're going to look at their price earnings ratio. All five of these companies have a similar price earnings ratio. General Dynamics is a little bit lower, but the rest are all in the 24 range. Again, Boeing has a slightly higher price earnings ratio than all their companies, but not by much. So all in all, I think the best company to buy here would be Boeing. Even though General Dynamics does have a slightly higher profit margin, I do think with Boeing's other ratios considered, it is the best company to purchase. And Lockheed Martin for this year would be the company that we're least likely to buy, despite having a high total asset turnover ratio and a decent price earnings ratio. I think its low profit margin definitely sways my opinion against it.